Welcome to Tracking Stocks, where we implement proven strategies from William O'Neill, Stan Weinstein, and Mark Minervini, the same principles that have guided the most successful traders and market tacticians for decades. Here, we combine technical and fundamental analysis to evaluate real opportunities. And today's focus is Plug Power Incorporated, ticker symbol PLUG, one of the most heavily watched names in the clean energy space. Plug is a U.S. company developing hydrogen fuel cell systems and electrolyzers, technology designed to replace traditional batteries and fossil fuels in logistics, transportation, and power generation. Its long-term goal is to build a complete green hydrogen ecosystem, from production and storage to delivery and on-site energy use. At Tracking Stocks, we always start with the chart, because that's where the truth about a company's strength or weakness is revealed. To analyze Plug's chart, we'll use the terminology of Stan Weinstein, who categorized every stock's lifecycle into 4 distinct stages. Plug has been in a stage 4 downtrend since early 2021. Back then, the stock traded above $75 per share, near the peak of the hydrogen energy mania. Since then, after a long, classic stage 4 decline, the stock has lost more than 90% of its value. That multi-year decline continued until May of 2025, when Plug reached its all-time low of 69 cents on capitulation-style selling volume. That low potentially marked the end of the stage 4 decline and the start of a stage 1 basing pattern, a phase where price flattens out and begins to build a foundation. Following that low, the stock rallied sharply along with the broader market, reaching a recent high of $4.58 in early October 2025. That rally came on expanding volume, levels not seen since Plug traded in its 2021 range, an encouraging early sign. But the rally failed. It ran into heavy overhead resistance in the $4 to $5 range, reversed, and has since corrected back to roughly $2.70. If Plug ever attempts another rally, it's going to face a wall of resistance. There's a thick band of overhead supply between $5 and $13.50, built over the past 2 years. This is not the kind of setup we look for. At Tracking Stocks, we focus on stocks that have clearly broken out of their stage 1 bases and are well into their stage 2 advances, moving cleanly and powerfully, without local resistance to slow momentum. Although the expanding volume from earlier in the year was a positive sign, the breakout failed, and the stage 1 base remains too early to confirm a transition into stage 2. In short, Plug faces too much overhead supply and too little confirmation for a sustained uptrend. The 13F ownership data tells the same story the chart does. Institutional ownership, the number of funds holding Plug, has been declining steadily since early 2022. At its peak, Plug appeared in nearly 700 institutional portfolios. Today, that number is down to roughly 450. That decline shows a lack of institutional accumulation, which is critical for sustained stage 2 advances. For a true uptrend to develop, we need to see rising 13F counts, clear evidence that big money is stepping in. Flat or falling ownership means institutions are exiting, not accumulating. So the 13F data confirms what the chart shows. Plug is still stuck in a stage 1 base without institutional support. Fundamentally, Plug's numbers don't inspire confidence. While total revenue has increased since 2021, it remains far below its all-time high of $891 million in fiscal 2023. We're looking for steady, year-over-year revenue growth, especially across the last 3 years, not erratic performance or declines. Even more concerning, both gross profit and operating income have been negative year after year. The company has never managed to post positive operating income. At Tracking Stocks, we prefer businesses showing positive and accelerating income growth, the kind of financial momentum that draws in strong institutional demand and supports stage 2 breakouts. Plug simply does not meet that standard yet. The statement of cash flows tells a similar story. Operating cash flow has been consistently negative, showing that Plug's core business continues to consume cash rather than generate it. To finance that cash burn, the company has resorted to issuing new common stock over the past 2 years, diluting existing shareholders. At tracking stocks, we look for positive operating cash flow that's growing over time, a clear indicator of financial strength and sustainable operations. Unfortunately, Plug does not fit that profile. To understand where Plug stands today, let's look at its backstory. Founded in 1997, Plug went public in 1999 during the original tech boom, positioning itself as an early pioneer in hydrogen energy. Its mission has always been to build a complete green hydrogen ecosystem, from production to distribution to end use. In 2025, Plug secured a $1.66 billion loan guarantee from the Department of Energy to fund up to 6 green hydrogen plants across the United States, beginning with one in Texas. The company also launched Project Quantum Leap, a cost-cutting plan targeting $150 to $200 million in annual savings through workforce reductions and tighter capital spending. Despite those efforts, the company continues to struggle with execution challenges, including supply chain issues, canceled partnerships, such as the one with Fortescue Metals Group, and analyst downgrades citing escalating headwinds. In October 2025, Plug announced that longtime CEO Andy Marsh will step down, with Jose Luis Crespo, known for building an $8 billion sales pipeline, set to take over in 2026. So the backstory is one of ambition versus execution. Plug's vision is massive, but its track record and financials still haven't convinced Wall Street that it can deliver. So what's the verdict? Technically, Plug is still deep in stage 1, with no confirmed stage 2 breakout and layers of resistance above current price levels. Institutional ownership continues to decline, and fundamentals remain weak. Negative income, negative cash flow, and shareholder dilution. Until we see a clean stage 2 breakout, confirmed by rising institutional participation and improving financial metrics, Plug remains a speculative turnaround, not a buy. At Tracking Stocks, we'll keep monitoring Plug for any signs of accumulation or technical strength. But for now, it's still a story in transition, not a leader in motion. Stay tuned for upcoming videos, where we'll continue applying proven methods from O'Neill, Weinstein, and Minervini, and show you how to spot the next true stage 2 advances before the crowd catches on. This is Tracking Stocks. Stop trading blind.